The stock market just finished its craziest week in years, and now investors are starting to get nervous. No, this time it's not because of tariffs, it's because of the United States economy and concerns about the United States dollar. This is one of the reasons why mortgage rates just spiked past 7%. And it's one of the reasons why gold prices are breaking new record highs is because investors are getting nervous. Not to mention that we just got a new report saying that layoffs are up more than 200% from 12 months ago. So let me break this all down, and I want to start with this. I don't care if you think tariffs are a good thing or a bad thing. The reason why you want to pay attention to this video specifically is because I want you to understand what's happening behind the scenes. That way you can make smarter decisions with your money to take better care of yourself, your family, and your community. Now with that, tariffs are no longer a threat, they are a reality. But the reality that we don't know is, what are tariffs going to look like in 90 days, 12 months, or 3 years? And that uncertainty has Wall Street a little bit confused. And Wall Street hates uncertainty. And this is why we've been seeing a lot of investors take their money out of stocks and look for a safer investment. Now, traditionally, when investors want a safer investment, that meant buying Treasury bonds. What's a Treasury bond? This means lending your money to the United States government, because every economist would tell you that lending your money to the United States government is a, quote, risk-free investment. Why? Because the United States government has the power to tax its citizens, and they have the ability to essentially print money through the Federal Reserve Bank. So the United States government has the ability to always pay back their bills and pay you back your interest. That's why it's considered a risk-free investment, but investors are not so certain anymore. Now, this is going to get a little bit technical, but if you stick with me, I promise it'll all make sense. So the United States government allows you to lend money to them by buying Treasury bonds. Well, investors have been looking for a safer investment, but they haven't been putting their money into treasuries. Now, when you think about where you want to invest your money, you have to understand risk versus reward. The higher the risk, the more reward you want. Like if I'm going to lend my money to my broke cousin Bunty or Jeff Bezos, I'm going to want a higher rate of return from my broke cousin Bunty because I don't know if he's going to pay me back, but Jeff Bezos has a lot of money, so I'm more confident he can pay me back. So less risk, less potential return. Well, the United States government kind of works the same way. They have the ability to pay lower interest rates when a lot of people want to lend them money. When the United States government is not getting enough investment, then they have to pay higher interest rates to incentivize you to lend money to them. Well, throughout the week, what we saw is that less and less people were lending money to the United States government. How do we know this? Because the 10-year Treasury yield started going up, meaning the United States government had to pay out much higher interest rates in order to incentivize investors to keep lending money to the United States government. Why? Because investors were getting concerned about the treasuries. Investors were getting concerned about the dollar. They're getting concerned about the economy. And so that required the government to now increase the interest on how much they pay out to people. Why does this matter? Well, because that treasury yield, that interest rate that the government pays, impacts how much money you have to pay on your mortgage if you're looking to get a new mortgage. If you're locked in, this doesn't matter. But mortgage rates go up, refinance rates go up as treasury yields go up. Because when a bank is deciding how much interest they're going to charge you on a mortgage or a refinance or a car loan or a credit card, well, it varies based off of what the treasury yield is. So when treasury yields go up, the interest that you have to pay on a new mortgage or a new refinance or a new car loan or your credit card also goes up. When the treasury yields go down, well, the interest rate you have to pay could also potentially go down. And this is one of the reasons why mortgage rates have been going up. It's because investors are getting concerned about the dollar and the economy. Now, this is something that we have been covering in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, stocks, crypto, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every single day, and it's completely free. Plus, if you join Market Briefs now, you'll also get a free investing masterclass just for joining. So if you want to get Market Briefs, I got the link for you to join down in the description below, and you'll also get the masterclass as well. This is what's creating a lot of uncertainty. it's the tariffs. And that uncertainty has been trickling into what's going to happen in the economy and what's going to happen to the dollar because people are concerned about inflation. And this is where also the Federal Reserve Bank has chimed in and said they don't know what's going to happen and they don't know what they're going to do, which has a lot of investors concerned because, well, they hate uncertainty, but it also creates opportunity. But I'm going to get to that opportunity in just a second. The CEO of Mortgage News Daily also commented on this bond yield confusion, where he said, quote, "Unless your career began before 1981, you just lived through the worst week you've ever seen in terms of jump in 10-year yields." So when we talk about the Treasury bonds rising, this is what I'm talking about, where it was the worst week since 1981. This brings us to the topic of layoffs, because we've been seeing a lot of layoffs in the private sector and the public sector. And it started obviously with DOGE through the United States government, because the United States government has been working to eliminate waste and to make the government more lean. And this has been a big contributing factor to the layoffs that we've been seeing. Now, if you've been reading the headlines, you know that layoffs are up. They're up more than 200% from 12 months ago. A big reason for that has to do with government layoffs. Not just private layoffs, but government layoffs. Now, this is kind of expected. We knew that the United States government would be going through layoffs if President Trump was elected. But the concern that people have now, and the question mark is, how much will these layoffs ultimately impact the economy? Because the United States government is a spender in our economy. In fact, they are the largest spender in our economy. Why does that matter? Because our economy runs on spending. The more money you spend, the more money somebody else makes. If you spend money at Chipotle, Chipotle can hire more people. And if more people spend money at Chipotle, they can continue growing. Well, the United States government has a lot of spending ability and a lot of spending control. And because of all the deficit spending that we have seen for the last 2+ decades, deficit spending means the government spending money they don't have. This has contributed to a lot of issues in our economy, including inflation. And this is where now the current presidential administration is working to reduce the deficit. This is not the first time a president said that they want to reduce the deficit. We've been hearing this for decades now. But now, in order to reduce the deficit, the United States government is working to reduce spending as one part of it. And as they work to reduce spending, that means people lose jobs. That means departments get cut. You can start to see it's a double-edged sword. Because if the government keeps spending a ton of money, well, it's good for the economy, especially in the short term. More people have jobs. More contracts are going to be sent to businesses. So it looks like the economy is booming because you have all this deficit spending, which is what we've been seeing for decades. But how do you fund that deficit spending? Well, it's been funded through debt. And that debt has to be paid back, plus interest. And this is that problem. It's the double-edged sword that, yeah, you can keep boosting the economy and kicking the can down the road, but eventually you're going to have to pay the price. And that price is paid through inflation and taxes. And so now the United States government is working to reduce the size of government. They're working to reduce waste and a lot of other things. But that comes at a price as well, because that means people lose their jobs, which is emotionally painful. It's financially painful. And we don't know what the true impact of this is going to be on the economy, not the United States government, but on the economy. Because if a government worker or a government employed business loses a contract or they lose an income, now that person no longer has the ability to pay for a mortgage or to pay for a car or to pay for groceries. So you can start to see the trickle-down effect of that, which we don't know just yet. On the flip side, if the government reduces spending, they can also reduce some of the deficit. It can reduce some of the need for national debt. And it can reduce some of the need of higher taxes. And this is where we have one more kind of wrench in this whole situation, which is while the United States government is working to reduce spending, they're also working to reduce their revenue. How are they doing that? By working to pass one of the biggest tax cuts in history. Now, again, you can hate it or love it. This is what's happening right now. So I want you to understand it. And the reason why I want you to understand the tax cut specifically is because this is having an impact on what businesses are doing. More specifically, how businesses invest their money. We just got a report in the business report on March 31st, which said, quote, surveys by business groups, including the National Association of Manufacturers, as well as the Federal Reserve Bank, are already showing a decline in investments in recent months after initial gains immediately following Trump's election. What does that mean? We have a number of businesses in the United States that have paused investment into their business as we try to navigate this uncertainty. More specifically, the uncertainty from tariffs and the uncertainty from tax changes. So businesses are saying, we don't really know what's going to happen in the economy, so we don't want to make a huge investment decision, so we're going to slow down spending. Why does that matter? Well, let's go back a few minutes ago. Our economy runs on spending. The more money you spend, the more money somebody else makes. Now, if you make $50,000 a year or $100,000 a year or even $250,000 a year, you have some buying power and some influence in the economy. But it's a little bit different when you're a business that generates $200 billion a year. Now you have a lot more spending ability. And a lot of that spending is going to be happening inside of the business. And now when you have a number of $100 billion a year businesses doing this, you can start to see the impacts. So we're starting to see more businesses say, we have uncertainty from tariffs, we have uncertainty from tax policy changes. And until we have a little bit more clarity as to what's going to happen, we're going to slow down some of our big spending decisions, which has an impact on hiring, which has an impact on economic growth. I mean, you can relate this to yourself. When people are concerned about, say, a recession, less people want to go out and buy a house or buy a car because that's a big spending decision for you. For a business, it might not be buying a house, it might be opening a new manufacturing facility. It might be opening a new research and development plant. It might be investing in a new division. These are big purchases that businesses are now starting to slow down on just because they want to see what's going to happen with tariffs. Are they going to work in the favor of the United States? Are the tax plans that are proposed actually going to get passed? And until businesses see some clarity, it looks like, based off of the data, that they're going to pause on this for a little bit. Again, I don't know what's actually going to happen. I'm just reading you what the reports are saying, which is why you want to understand how the entire economic system plays a part into one another. And this is one of the reasons why we've been seeing a lot of investors turn to physical gold, which has been going on for a number of years now because investors have been concerned about inflation, they've been concerned about the dollar, and gold has been a currency since many of us have, well, actually all of us have walked the earth. Gold has been a currency long before any of us have been here, and it'll continue to be a currency after us. It's been a form of hard money, but it's not really an investment in my eyes. It's more of a hedge. Yes, I've been buying gold for many years. As a disclaimer, that's just a small piece of my investment portfolio, but we've been seeing more investors buy gold out of these sort of concerns. So what does this all mean for you? Well, it means you want to be able to find the opportunity. Because for a lot of people, all this news means panic, it means fear, it means sell, it means a lot of emotional stuff. But at the end of the day, what we know is that uncertainty is a part of our economy. If we go back in time to 2020, it was a wild period in our economy where everybody said, this is over, our economic system is done for. And even if you bought at the peak, before markets crashed in 2020, you just owned a broad piece of the stock market. Maybe not individual stocks because obviously some companies went bankrupt, but you own the S&P 500, which is a group of the 500 largest companies in the stock market. If you bought right before the crash, you would still be profitable today. In fact, you'd be pretty profitable today, even after all the craziness that we've been seeing. If you bought at the peak before the 2008 financial meltdown, you would still be profitable today. The reason why I say this is a lot of people say they want to be investors, but then they have this narrow focus of time. If you are an investor, you got to look at it from a broader time horizon. What happens over the next 6, 12, 24, or 36 months is a drop in the bucket because you're looking at it for the next 10 to 20 to 30 years. And when you look at it from that type of time horizon, volatility creates opportunity. Ups and downs create opportunity. And you just keep buying through the craziness. When markets go down, in fact, it creates an even better buying opportunity because recessions and market crashes create more millionaires than any other time. And they create opportunities to buy. Now, we talked about this on my channel throughout the craziness that we've been seeing. And I know a number of people left comments, and you can go and just watch the videos and see the comments, saying I would not touch the markets with a 40-foot stick at this time because things are going to implode because of tariffs. And then we saw things kind of stabilize and go up and down. But what I want you to understand is when you look at it from a day-to-day perspective, you're not an investor, you're being a trader. But the real wealth is built by investors. And that requires you to, number one, have a little bit of faith in the United States economy over the long term and have a long-term mindset. See, a lot of people want to get rich tomorrow. There's a lot of gurus on the internet selling you programs on how you can get rich with whatever system in 6 months. Well, investing doesn't work like that. Investing is how do you build wealth over the long term. It's not so easy. It takes time, it takes discipline, it takes focus, and it takes consistent investing. And this is where, when you understand that, you don't have to worry so much about the day-to-day swings. In fact, you can kind of predict when things are going to go wild. The first time tariffs really became a thing, a tangible thing in 2025 was February, when President Trump first passed tariffs on Canada, Mexico, and China. That's what triggered the initial sell-off in February. And then we saw the 30-day pause. Well, the 30-day pause eventually came to an end in March. And then came the downturn again in March. And then we had a little bit of another pause where we said, wait until Liberation Day on April 2nd. And then came Liberation Day on April 2nd. And then we saw another dramatic drop in the stock market. And now we have a 90-day pause. Now, I don't know what's going to happen over the next 90 days. I don't know what's going to happen after 90 days. But chances are we're going to see volatility. I believe in the United States economy. Now, I get it. I'm a random guy on YouTube. And you should never take advice from a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But for me, this is where I look for opportunity. And I'm going to give you a little bit of a personal story here. I don't say this to brag, but I say this just to make a point. In 2022, when markets fell by 20%, I was buying aggressively. In 2020, when markets fell by 40%, I was buying very aggressively. After the 2008 crash, when housing prices were slashed, I was buying aggressively. I was fortunate to get involved with investing after the 2008 crash, but these are the times where people get tested. And you can either use it as a time to find the opportunity, or you can use it as a time to panic. I want you to understand the opportunity, okay? I'm saying this because these are things that I was never taught before. And you don't have to find the next Nvidia, you don't have to find the next Amazon, you don't have to find the next Tesla. You can just own a piece of something like the S&P 500. This is a group of the 500 largest companies in the stock market. And when you do that, you're just owning a piece of the United States economy. How do you do that? Well, there are ETFs out there that allow you to do that. For example, SPY. SPY, that's one ETF that gives you exposure to the S&P 500. Another one is VOO, that's one that I'm personally invested in myself as a disclaimer. But these are ways for you to get exposure to the S&P 500. And the way you win here is through a strategy called ABB. Always be buying. Set up a system and then turn it off. You have a buy every week, every 2 weeks, every month. You set it and you forget it. When I say turn it off, I mean you close the app and you don't worry about it. You don't even think about it. Delete the app off of the phone if you want. But now every week you're just buying $50, $100, $200, $1,000, whatever you can afford. You're buying a little bit of money into the fund every week, every 2 weeks, every month, and now you just forget about it. And now you let the markets do their thing. If anything, the only change you make is when you start to see big downturns, you buy a little bit more. This has been a proven strategy to build wealth over time. Not over 6 months or over 2 years, but over 10 plus years. It has been a proven strategy to build wealth. And then you just let the markets do their thing. You don't worry about the noise, you don't worry about the emotions, you don't worry about the crazy swings, you don't worry about tariffs, you don't worry about all that other stuff. You just own a piece of the economy and you let the markets do their thing. But this is where it requires you to have the basic level of financial education to, number one, stop spending all of your money, don't get caught up in the emotion, be smart with your spending, and be aggressive with your investing. And that's where the wealth is built. Because a lot of people want to argue politics, they want to argue over whatever stuff that they don't even understand, which at the end of the day doesn't really matter. I want you to focus on the things that will continue to provide for you and your family and your community. That way you can have real financial freedom, pay for your kids' college, pay for your parents' health care, provide a better life for your kids, and provide a better life for you, your wife, and your husband. But that requires you to actually trust the system, put in the process, and become an investor and stop being a trader. Again, if you want some more resources, you can check out Market Briefs, which is my free financial newsletter, and get the free investing masterclass. And I have a ton of videos on my channel. And with that, I will see you on YouTube on Monday.